Hi, I'm Debbie from Property Apprentice. Today's podcast's about fixing or refixing your mortgage and some things to think about when you're going through that process. Fixing or refixing your mortgage isn't one of the most exciting parts of owning a home, but no matter how boring it is a vital part of the property purchasing process, and getting it right can help to protect you from financial strain. There are many factors that you need to take into account so you can structure your mortgage in a way that benefits you. In today's podcast, we're going to list some items to think about when you're at the point of either fixing or refixing your mortgage interest rate. Number one, expiration of your fixed interest rate. When your fixed rate interest term matures, you can either refix or switch to a variable rate. There are pros and cons between these two choices. The best choice for you is based on what works for your current situation, future financial goals, and the market trends. You should ideally review your home loan at least 3 months before expiry, so you've got plenty of time to make changes when they are needed. If you have a split home loan, it's important to keep a record of different expiry dates so you can avoid getting switched automatically to less desirable rates. If you don't have a split home loan, you might like to discuss this option with your mortgage advisor to help reduce your risk during periods when interest rates are increasing. When it's affordable to do so, you might also be able to pay off your mortgage at a faster rate by paying more than the minimum mortgage payment required. For example, when interest rates decrease, you might decide to fix your mortgage at a lower interest rate, but keep your mortgage payments at the same level that you were paying previously. Number two, paying attention to market trends. There are a number of moving parts that determine where the property market and the economy are headed. If inflation's high, interest rates tend to increase. Because forecasts can get very technical, if it's easier for you to think of in terms of your own personal risk tolerance and financial security, then do that. There are things that you can discuss with an experienced mortgage advisor. Locking in rates for a long time does mitigate the impact of higher interest rates, but it can also stop you from benefiting from rates going lower in the future. Your mortgage advisor can also help you to decide if you're more suited with locking in a rate now or taking shorter fixed term periods. Number three, what's your situation telling you? Let's break this down into two. Number one, so part one, things affecting you and your finances. Take time to make a forecast of what the next 2 years looks like for you. List down life events that you anticipate taking place, which will have a huge impact on your ability to spend and save money. What's your job status? Making consistent payments towards your mortgage is ideal, but if you're faced with job insecurity or unexpected scenarios like illness or redundancy, you might also want to consider your options to lock in lower payments or consider a revolving credit or offset loan facility. On the other hand, if you're getting a pay rise or if you're getting bonuses, large commission payments, or proceeds from the sale of another property, you might want to increase your regular payments or give one large one-off payment so that you can make a significant dent on your remaining debt. Your mortgage advisor can help you with this decision as well. How much savings do you have? If you have any extra savings, you might want to do a lump sum payment towards your mortgage. This goes towards the principal of your home loan, which means paying less interest in the long term. Alternatively, you may be able to offset those savings against the interest that you pay on your mortgage. Are you reaching a major personal milestone? In most cases, this can be starting a family, approaching retirement, launching a business, or being faced with a big emergency. Make sure that any payments you fix now will still be manageable in the coming months if your income's going to be reduced. Sorted.org.nz is a great resource for tips on how to budget your income and expenses. And then number three, part two, is when you're thinking of selling your property. When you fix a rate with the bank, you need to commit to pay them interest over the period of that fixed rate. If you decide to sell your house, you might need to get yourself out of this obligation by paying a break fee or an early repayment penalty fee, which can sometimes be quite a hefty amount. Note that some quotes for break fees are only valid for 1 day or less because the pricing calculations are based on current numbers, which can change regularly. Depending on how long you've had your mortgage, there might also be a commission clawback that you could be liable for. Your mortgage advisor should have already discussed this possibility with you, and they can certainly let you know how much the total cost of bank fees and any commission clawbacks, if anything, if you choose to sell. When deciding whether to fix an interest rate and for how long, keep in mind those break costs. On the other hand, if you leave your mortgage on a floating rate, the interest rate might be higher than on a fixed rate, and your mortgage payment can change as interest rates change. So you need to allow for this before your property sells as well. Again, your mortgage advisor can help you to make that decision. If you're looking for a good mortgage or insurance advisor, we recommend MITeam. That's MITeam for mortgages and insurance. They've got access to a large range of insurance providers and lenders, so they can find the best fit for you as a person. Get in touch with them via the website miteam.co.nz or email office@miteam.co.nz, or give them a call on 0800 88 22 99 to discuss your options.